All right, so what do we do? There's 4 pillars to our business. We do training and education, which is part of what we're doing here tonight. As we open up, we'll get into more property tours, which is a phenomenal way to get out, hands-on, get into some in the field kind of training and knowledge sharing, strategic planning. So for us, yes, we're realtors, but we're investors first and realtors second, and that translates into what we do and how we do it. In that, if you know, we're long-term relationship people. All right, so thanks everybody for joining. This webinar is all about a number of things. So we're going to go through a little bit of what we do here at Blue Orchard. We're going to talk about, as the title suggests, the fundamentals of real estate investing, some of the foundational items, which are more important than ever today, right? We see a market, we've been in a market for a little while. It's been changing quickly, but in one direction. And now we've seen a bit of a pullback in the last couple of months. Interest rate changes, some pullback in the market. And it's really important now more than ever during, you know, a course change, right, to understand, reorient with the fundamentals, reorient with strategies that we know are effective and that we know work really well in both markets, in the one that was increasing like we were in, and in this one that's changing. And there's a number of data-driven kind of examples that we're going to use to talk about that changing market, why the strategy is good, and as always, for you to evaluate for yourselves. But it's important for us as a team to share this information with you so that you can make the most informed decisions possible. All right, so let's dig straight in. First, a disclaimer. Blue Orchard Property Group does not endorse any particular attendee, participant, speaker, investor, sponsor, advertisement, or anything else presented during the meetings. We also do not guarantee the accuracy of information during the presentation on our website or social media platforms. Blue Orchard Property Group and its affiliates are not financial planners. And before taking action, as always, do your own research. This applies to just about anything, but especially real estate investing, along with those other things in life. So with that, let's jump right in. So Blue Orchard Property Group, we are an investor-focused team of realtors. We've helped tons of investors throughout the GTA with proven recipes and strategies. We are investors ourselves and are implementing these exact same strategies. So we have a front to back solution to be able to guide and help investors, which we'll get into here in a minute. First, a quote to get us started off: "The road of life is paved with flat squirrels that couldn't make a decision." Such a good quote, and one that we love because it represents one of the most common pitfalls for investors, which is indecisiveness, right? And there's 2 main drivers that lead to a lack of decisiveness. One is lack of information, good data. Lack of knowledge goes right hand in hand with that. And the other one is fear, right? Closely related, but separate points. And so we're going to cover a bunch of that in the presentation tonight. And again, we're in a market that's changing, so it's as more relevant than ever. All right, so quick introduction to the team. We've been investing since 1992 in both US and Canada across a number of different strategies. Wholesales, flips, RTOs, student rentals, second suites, garden suites, apartment buildings. Today, we focus mainly on BRRRR in residential and in commercial, meaning forcing appreciation, refinancing, hanging on with second suites, garden suites in the residential world, and in apartment buildings in the commercial world. In 2021 alone, we helped investors with over 18 million in investments. That's the purchase price, not the ARV, because again, our model that we guide and consult and coach on is heavily based on what we do, which is forced appreciation, which we'll cover, forced versus natural. We'll get into that. All right, and we're out there speaking, regularly contributing to Canadian Real Estate Wealth Magazine, speaking at conferences, speaking in our own events, putting on property tours. We're out there quite regularly doing that stuff. And so we'd love to see you either on these Zooms with the digital online collaboration, or in one of the in-person events as we kind of implement those and get kicked off on that front too. All right, so what do we do? There's 4 pillars to our business. We do training and education, which is part of what we're doing here tonight. As we open up, we'll get into more property tours, which is a phenomenal way to get out, hands-on, get into some in the field kind of training and knowledge sharing. Strategic planning. So for us, yes, we're realtors, but we're investors first and realtors second, and that translates into what we do and how we do it. In that, if we're long-term relationship people, so it's never about closing a deal today. It's unless that's the right deal. It's always about what is the long-term win. So never short-term win, long-term loss. It's either got to be a win on both sides or a win long-term. And that's where the strategic planning comes in. It's really about that. Ultimately, no matter how our engagement is structured, we're here to try and create a bunch of wealth for you down the road, 5, 10, 15 years. And that's where the data-driven knowledge sharing stems from and is driven from. Thirdly, passive investing. So there's a suite of product offerings that we have from true hands-off. There's a lot of conversation out there about passive investing in buy and hold world. It's not actually passive investing, it's a business, and it'll serve you really well to think about it and run it like a business. It's not as active as a flip and buy and hold, but it's not true passive. Partnering is true passive. Now there's strict criteria around who we partner with and how, but if you're interested in true hands-off investing, that would be it. All the way over to guided investing, where we're walking with you and consulting with you every step of the way, and you're doing the work. We also have construction momentum consulting, where we'll take care of the reno during the forced appreciation phase. So it's an end-to-end solution. For a lot of investors, that reno phase is concerning. They're not experienced in that area. We bring our expertise to the table and shield the investor from a whole bunch of that work. And then the investor owns the property for the longer term. So that is a great hybrid model that we also do. All right, so we have a very specific formula that we follow for investors. And again, this is not about, finding a property and seeing if you like it. Like that's, we used to call that the catalog sales approach. We're not doing that at all. We're really trying to understand. It starts with you telling us what your goals are. And this is like business analysis, right? Like trying to extract that information, distill it down, try to get to the root of what we're really trying to accomplish on your behalf is step 1. 2, we'll either help you, or if you already know, we want to understand your capital and title qualifying power, right? That's really important. Then we can help you understand, are you in a position, what fits you best, what market, a primary, secondary, and tertiary, and we'll talk about those and the differences between them here in a moment. And then what strategy, right? Do we want BRRRRs, apartments, RTOs, flips? What fits you best? We consult, we do, specific portions of those, but have experience in the others, as I mentioned earlier on, and can direct you toward those if those strategies are the ones that fit your goals the best. Now, vetting deals, right? Running analysis on a deal, as it relates to your portfolio, for example, is related but different. We also are heavily involved in that. Of course, as realtors winning the deal. So what is going on in the market? Are we in a buyer's, a seller's, a balanced? What kind of market are we in? That influences the type of offer strategy, the type of offer approach that we would do. And then running the renos, right? This is again back to construction momentum consulting that I mentioned earlier. We'll help you either in a consultative fashion or in a very hands-on fashion with that renovation, finding the contractors, running the reno, structuring the contracts from front to back to try and make that as quick, easy, stress-free as possible. And then refinancing and getting to profitability, placing your tenants. Whether you're self-managing or you need a recommendation for good property managers in your area, we can help with those. So this is the signature recipe that we follow when we're consulting and helping investors with their investments. We have a very succinct philosophy that we like to orient around as it relates to engaging with investors who are looking for knowledge and information. And that is what we refer to as informed action taking. So there's pitfalls on both sides of this equation. Right? On one hand, you don't want to get into analysis paralysis, perpetual learning, never moving, but always educating. it's great, right, to educate, but we do have to move, and that's where the action taking comes in. We also, on the pitfall on this side, we don't want to be jumping before we have critical mass of information. Ultimately, we're trying to get to, call it 70, 80% of the information. Then we start moving. We learn fast when we move, but we don't want to move without that 70 or 80%. And that's what the education portion of our business is about, is trying to share that information, get that foundation in place. And nothing is educational like movement, like action. So that's when we fill in the 20% that remains through action, learning, refining, and adjusting as we go, right? So informed action taking is a fundamental tenet of how we approach investing and the investors that we consult with. All right, so why real estate? Let's start with this. Again, this being a foundations webinar, we really want to start with, and again, in a changing market especially, why real estate? Why are we looking at this and trying to assess it for whether or not it fits us well? Well, there's a few things we want to start with, and we're going to start on a global level, and then we're going to get right down to regional, and we're going to kind of drill down more and more as we get into these next few slides. And why are we thinking that real estate is a good thing to assess to see if it fits you? So this study, you can see the URL here down at the bottom. This study is a pretty impressive one. So the link's there. If you want that link, just email us. Their contact information will be at the other end of the presentation. We'll be happy to share that with you, along with any other data and reports and studies that we cite along the way. Just email us at the end with that contact information. We'll be happy to send that through. So this study, very impressive. So 150 years of data. That alone is impressive, across 13 of the major centers around the globe. So 150 years of data, global, and all investment types. And real estate outperformed everything. And that is critical, right? And so if you take that piece of information, what few things have that kind of track record associated with them?
Sorry, Chris, just for a second.
Yeah.
Oh, it's okay. Peter had lost audio, but I was just checking if anybody else had lost audio, but somebody else has said no, they've got it. It's okay.
Okay. All right. Well, maybe just maybe just Peter, check in with us here if you've got an audio issue on your side. Hopefully we can get that resolved here. Yeah, so I mean, when you look at 150 years of data, 13 of the major centers around the world, it outperforms everything. That is critical for us to understand, especially in a market. Well, real estate's always changing, right? It's always adjusting, like everything in the world. It's in a constant state of adaptation. And that is another data point related to this study that's also very important, because we don't want to be rattled by change. We want to expect it. We want to know that it's there, but we also want to look at the trend over the last 150 years and say, ultimately, yes, it changes from month to month and sometimes week to week and quarter to quarter, but ultimately it keeps increasing as the study shows, and outperforms all other investment types globally across the last 150 years. So that is a great kind of foundational stabilizing data point to operate from as we look at, the interest rates rising and the market pullback or market increases like we felt for the last couple of years. It's super important to see that trend and start to make strategic decisions from this type of data. Now let's drill down a little bit. We'll talk about the GTA in the last 53 years. So since 1967 right through to 2020, the average appreciation year over year is 7.08. That's blended over the last 53 years. If you think about that, that's pretty phenomenal, especially as it relates to the information that we're continually barraged with in the open media. Why that's so important is because I lived in California for a period of time, and whenever there was a slow news day, the media would jump on the fact that we lived on top of the San Andreas Fault, it was going to erupt, and everybody was going to be in trouble. And it's similar here with real estate. Whenever there is a slow news day or a pocket to fill in terms of clickbait, it becomes about real estate and whatever it's about to crash. I mean, these headlines of real estate bubble bursting have been going on for years and years and years and years. And that's why, as investors, we want to cut through that noise. We don't want to ignore it and holistically just block it out. but we definitely want to cut through it and see and get to data, right? What data can we work from here that is actually far more compelling than a clickbait headline? And we started with the global, now we're down to GTA. The last 53 years, 7.08. We'll talk about this in a minute. 7.08 is just the appreciation, doesn't speak to cash flow, doesn't speak to mortgage pay down, doesn't speak to leverage, equity, future opportunities. All of those things are in addition to the 7.08. And that's part of the reason there's this multifaceted aspect of real estate investing, is part of the reason why real estate has outperformed everything over the last 150 years. So again, a really important and compelling data point for us to operate from as investors. Now let's look at some other data points that are also what I consider to be calls to action, right? These things are extremely compelling when we think about us, the next 10, 20 years for ourselves, and then also for next generations, our kids, their kids. This graph shows the market appreciation versus the income. You can see down at the bottom here, the red line represents income increase, and relative to the market appreciation, you can't actually see it increasing at all because it's so slight. And that again, really important. So what does this mean for us? It means that the ability to qualify from one year to the next gets reduced. And so for an extended period of time, interest rates were being lowered, amortizations get extended, living quarters get smaller. All of these things are done in an attempt to increase affordability, but ultimately the trend is undeniable. So this means that every year, about 10 to 15% of the people that could qualify last year can no longer qualify this year. Now, that's super important for us. So what does that mean, again, for us as investors looking out over the next 10, 15 years, and then our kids and their kids? It means the affordability of real estate, again, I'll just insert that 150-year study. The affordability of real estate gets less and less and less. Now, it depends how you look at that. You could look at it as a call to action to acquire real estate, at which time the real estate that you own, you'll be happy that it's going up. Or you could look at it from the other lens, which is, well, that's unfortunate because affordability is going to disappear. I think it will remain there. The question is, in what proximity to major markets, right? Meaning that as affordability becomes more out of reach, then you'll have to go more and more and more peripheral to the epicenter of the major markets. So for me, that's a very compelling data point. It's something that I act from. It's something that I consider to be a very strong call to action. It's something that I'd actually talk to my kids about as well. So yeah, a very, very important data point for sure. Now let's talk about inflation. So back in October, the inflation rate was reported to be 4.7%. That's several months in a row over 3%. And the question is it actually higher than 4.7? I see lots of headlines come by that are significantly higher than that. But no matter what, what's clear is that with inflation as high as it is or increasing, your money is shrinking, meaning if inflation is sitting at 4% and I have $100 sitting in my bank account, sitting dormant, or cash on hand of $100, in a year's time, that's going to be worth 96. So your money, this isn't obviously meant as a scare tactic, but it is, again, a very serious call to action. How are we going to combat inflation? How are we going to not just make our money worth as much in a year as it is today? That's not the goal. The goal is to make it grow. So how do we find ROI and the ability to kind of make our money work for us, outpace the effects of inflation? Well, this is what we're here to talk about today, is how strong is real estate? And is that a part of our solution to what we know is going on with inflation? If so, how big a part? And in what ways, and what markets, what strategies, all of that. Okay, so let's dig in a little more here. So we happen to, that 53-year trend of data that I talked about is awesome because it's driven from the GTA. One of the, we live in our backyard is one of the best markets that you can invest in. So why is it good? It's not just kind of for no reason, right? It's good for a number of different kind of data-driven economic macro factors. If we look here on the right-hand side, this map, this whole big dark green space is protected land. It's all protected green space, one of the largest in the world. And that does a few things. It, with the lake down below and the green space up above, this whole area in the GTA is landlocked. And that's done for a reason. The provincial planners put that green space in place so that density increases. And I'll talk more about density. There's more steps taken to increase density over time. But ultimately, density is better, right? It's a more profitable model for provincial planners because it's more tax dollars per square foot. Without that green space, without mandates for density, you end up with sprawl, more sewers, more garbage collection spread out over more area, more parks to maintain, less tax dollars per square foot with more infrastructure is a bad model for profit. So this green space is there to facilitate and encourage density, as are a couple of other bills that have been passed over the last 10 years, which we'll talk about in a minute. So we have land scarcity in this area. We have population growth. Somewhere between 150 to 200,000 new immigrants come into the GTA every year. Many of those immigrants are affluent. They're looking for housing. They can't necessarily buy on year one. Often they wait till year two. And that's also really important for us as investors. Because, if we own buildings, well, that's lots of people looking for rental units. And if they're ready to buy, that puts pressure on the market. So we've got a supply and a demand issue that is an underlying fundamental issue in the area that isn't impacted by anything that's going on today, meaning it's still there. It's still a fundamental tenet of what's going on and why the investment market is strong, regardless of the details of what's happening up above those data points. So a lack of supply. We've been in a seller's market for quite some time. We still are today. It's a little more balanced than it was for sure, but it's still a seller's market, meaning the supply and demand issue is creating an issue where there just isn't enough housing. So regardless of interest rates rising, regardless of those types of things, we still have a fundamental supply and demand issue that makes it very compelling for us as investors to keep investing, right? This is still a good investment. Those data points of 150 years and 53 years are still continuing to be very strong. Transportation funding. We see GO train expansions in the east and in the west and in the north. There's major highway development and improvement and extensions happening all throughout the GTA, which is huge. Canadian desirability. In 2020 and 2021, Canada ranks #1 in the world from the Wharton studies that have been put out. And again, that speaks to the 150 to 200,000 new immigrants coming in every year. Canada is a very desirable place to live, and the GTA is one of the most desirable within Canada. Again, we can talk about interest rates and we can talk about balanced buyers and sellers markets, but this supply and demand issue, this housing issue, is not going away anytime soon, at least not in our opinion. So I mentioned the density in a couple of bills in the last 10 years. Bill 140 was introduced in 2012. This ultimately has a lot of information in it. It distills down into Bill 140 is all about second suites. So second suites, we're taking a single family home and retrofitting an apartment in it. That's an important distinction from a duplex itself. It's a technical distinction, but it is an important one. And why is this so good for us as investors? We're going to get into this, but what's important to know for right now is that Bill 140 is about second suites, so retrofitting within the existing building another apartment, another standalone, mutually exclusive apartment within the main housing unit on a property. Now in 2019, Bill 108 was introduced. What is that? That's about ADUs, additional dwelling units, which is another living quarter, mutually exclusive, largely, but separate from the main house on that same plot of land. So what are these two things? They are, they represent a few things. They represent the provincial planners passing bills that ultimately mandate more density. So both of these things speak directly to that landlocked area and increasing density over time, one through second suites and the other through ADUs. So very, very important. Now, also, there's a task force within the province to address this housing issue. If you read this headline right here, it's saying task force urges more housing density, less time spent consulting public. Basically, some of what they're saying in there is we should be able to roll out second suites or garden suites in an area, in a region, without consulting the public and doing it because we need to move faster to solve the housing crisis. That's huge, right? That's, it doesn't mean that that automatically gets put into motion. It means the task force was created, one, again, just the fact that it was created, right? This task force is there to help consult on how to solve the housing shortage. And their recommendation is we need to move faster with less obstacles in order to get there. If all we did was look at that data point, that's a pretty compelling one, but we've got many others, some of which we've already covered and some of which we will cover, that speak in addition to the fact that a task force was created and what it's recommending. All right, so a proven template for success, the last 10 years and the next 10 years, and it speaks directly to the two bills that we just talked about. But let's dig into some of this detail. All right, so I mentioned in the beginning, and for some of you, mentioning the acronym BRRRR may be a little bit still new or foreign. Don't worry, there'll be avenues for you to get more information, get more time with us to be able to share more information around many of these concepts. We'll cover them on a high level here now. So BRRRR stands for, ultimately what it is a flip and a buy and hold put together, right? So we know in a flip, we know through watching HGTV that when you flip, you buy a house and 20 minutes later, it's completely transformed and you sell it for, $1 million profit. But seriously, the flip, we know that we're buying, I talked earlier about natural versus forced appreciation. Natural appreciation is that 7.08% over the last 53 years in the GTA that I talked about. That's the supply and demand issue organically influencing the market and the prices over time. Forced appreciation, usually done through renovation, with some exceptions, like in apartment buildings, not always. But in the residential kind of investing world, almost always through renovation. And so what are we doing? We're buying a property, we're renovating it, and we're forcing up value. In a flip, we sell it for profit. In a BRRRR, step 3, we refinance it and we take some profit out of the building and we hang on to it in a cash flowing state for the long term. And then we rent in a profitable state. The good thing is that our analyzers, which we'll show you in a minute and are freely available to you guys, cover all of these 4 stages up front before we even make an offer on a property. So we know this signature quite well. We've run this analyzer and we've analyzed literally thousands of deals. Our analyzers are set up to be quick and easy and fast and informative to tell us, is this a good BRRRR or not? There's more steps that we take once we get the initial check mark that, hey, this thing looks good. And yes, we should pay more attention. Yes, we should probably look at it in more depth. Then we go into, step 2 of the analysis. But ultimately, this BRRRR strategy, had I known about BRRRR years ago, again, investing since 1992, I would have started to implement it way sooner. I would have done much less flips and far more BRRRRs. It's a very, very powerful strategy. Today, I do BRRRR in these duplexes and garden suites in the residential world, and I also do BRRRR in apartment buildings. So the model is very, very good. It's a generic model to force value, pull out profit, and hang on. It's a very, very powerful model that can be used. The details by which you force appreciation change from, context to context, but the framework stays the same. So that's the BRRRR model in a nutshell, and lots more to be covered there, including financials, which if you wish, we can kind of get into that more, and there'll be ways to contact us at the end. Okay, so I talked about the last 10 years and the next 10 years. Last 10 years have been characterized largely by second suites. They were rolled out, same as I mentioned earlier, in a bill in 2012. And part of the mandate of that bill is that each municipality has to implement a process by which people can retrofit second suites into their homes. Now, they have the latitude, the municipalities that is, have the latitude to roll it out within a certain time frame, so that it doesn't all happen at once. But more and more, those strategies get rolled out, and they're implemented more and more across different municipalities. Early adopters of second suites have a first mover advantage, and there's pros and cons to that. And that's important as we look at the next 10 years and how we strategize on the next opportunity and when and how we engage in that next opportunity. Really, really important. And so the point there is that early adopters, again, have a first mover advantage. What does that give you? It gives you more inventory to pick from. It gives you more, a stronger ROI typically, better cash flow typically. And it gives you, you can kind of ride that wave of more and more refis, more and more value being tied to a second suite investment property. So the con though is that when it's first rolled out, you're kind of in technology we used to refer to this as bleeding edge versus cutting edge. And bleeding edge is, you're right out there on the very thin edge of the wedge, the very forefront of the initiative, and you're carving a path, right? Cutting edge is, it's still new, but it's largely proven and stable. And so I would say, where are we at with second suites? It's neither. It's a very strong strategy, very, very good strategy, but it's neither bleeding edge nor cutting edge. It's very, very well proven. We kind of joke that, investing in second suites is like a flight. We want it to be boring. We almost, once you've done 2 or 3 of them, it becomes very rinse and repeat. First 1 or 2 for people is new. And so there's a learning curve there. That's where we come in to be able to help with a bunch of that. But largely it's rinse and repeat, the same thing over and over again. And, if we want thrills, we can go bungee jumping, but investing, let's make it predictable, repeatable, scalable. These are the things that we're looking for with good control, strong ROI. That's what we're looking for. And second suites are very much that. Now we have an opportunity to engage into the next kind of iteration of density through the bill that was introduced in 2019, the ADUs. So secondary dwelling units or additional dwelling units. These are newer. Now, are they bleeding edge? I wouldn't say so. We're not splitting the atom here. This isn't like a brand new invention, but rather it's a new implementation of almost an identical density model that we've just seen. That gives us the benefit of knowing largely how this is going to evolve over time. And we can still have that first mover advantage. We don't have to be on the bleeding edge with all the trailblazing and the risk and the effort that comes along with that. We can be on cutting edge though. It gives us that first mover advantage. And remember what that is. That is typically better options, like more inventory out there to choose from. That is true to a certain degree, although we still have to hunt for these things. We have to know what we're looking for. We have to vet them quickly, and we have to jump on them when they're there. It does still though give us very strong cash flow. It gives us much stronger projected ROI than we could get with just a secondary suite today. And so again, the really big thing is here, like we've seen this play out. Like we already have a perfect model for this over the last 10 years for how ADUs are more than probably going to behave is exactly how second suites did over the last 10. So that's great, right? Like this is, again, that proven kind of model already having played out is part of the reason why these ADUs are cutting edge, not bleeding edge. We kind of already know what this looks like. And the financials that we run on them also prove that, right? And we'll talk about that. Like they produce strong cash flow. Cash flow in the market doesn't just sit there. It's going to get consumed with higher values and reduced cash flow down to about 200 to 400. I'll talk more about that in a minute. But the point here is that the second suites, they're still a good thing today. But when you combine them with ADUs and the garden suites, it becomes really, really compelling. And this is where we have a very unique opportunity over the next, I would say, 2 to 3 years to kind of still be in that first mover advantage. And we have a very specific strategy that we would propose that you think about and consider that we recommend that is tailored directly to this landscape that we're in the middle of. Okay, so what does this look like? I just kind of alluded to this. So we've got two strategies now being combined together, both falling into the generic framework of a BRRRR. We've got a second suite and we've got an ADU strategy, both very similar, but again, slightly different. So what can we do? We can do a couple of things. You could look for properties with land that were conducive to ADUs in markets that already have ADUs approved and a process by which to implement them. And you could do it in a big bang approach, meaning you buy a property that's a single family home, you convert it to duplex and put in the ADU all at once, call that, somewhere around a $350,000 rental to do both of those, 350 to 4, because the rental prices are increasing. And then you refinance, you pull out profit, and then you rent all 3 units all at once. Or you could do this hybrid approach, which has a lot of benefits. Hybrid approach meaning in phase 1, you purchase a single family home, it's conducive to second suites, it's aligned for what we believe is conducive to an ADU. And let me just explain that for a second. What I mean by we believe it's aligned for that is the markets throughout the GTA are in varying states of readiness for ADUs, meaning Barrie is a front runner, for example. It's had ADU process rolled out for a little while now. Now they just evaluated and adjusted that process and the criteria by which you implement ADUs. And then Brantford has it, Oshawa does not, Peterborough's in a hybrid state. So the different markets throughout the GTA are in different stages of rolling out their process for this and their allowance of this. And so that's what I mean by, we already know what second suites require definitively in each market because it's been rolled out for a while now, depending on which market you choose. And again, there's pros and cons to each and where it's at. But depending on which market you choose, we may be extrapolating from another market and saying, we believe that largely the criteria by which ATUs will be allowed is going to be very similar to the adjacent markets. And so we'll take, if we're going to do Oshawa, for example, you could buy in Oshawa, take the criteria from Barrie, assume it's going to be pretty close, buy properties that match that criteria, put in a second suite and know that you're well aligned for an ADU down the road when Oshawa rolls it out. So point being here, phase 1, buy a single family home, implement the second suite, set it up to cash flow and let it do its wealth building thing across appreciation, cash flow and mortgage pay down for the next 2-3 years. Let it accrue its wealth and then refinance it again, use the refinance money to then put in an ADU, run that reno, and then implement your renter in there. Now you've got 3 rents coming in 1 parcel of land. And now you're set up to be in a very strong wealth building position. It just gets stronger and stronger. So that's the kind of 3-phase approach. Phase 1, buy the home, put in the second suite. Phase 2, let it do its wealth building thing. Phase 3, refi and fund the ADU from the refinance allowance. So you kind of minimize your capital. We refer to this as landlocking. So can you purchase properties today for second suites that have bigger parcels of land, knowing that you're going to be in a good position to put in ADUs down the road? That is a great hybrid model that comes with a bunch of benefits. So what are those benefits? We minimize our capital up front, meaning we don't have to do the big bang approach of the second suite and the ADU all at once. We actually use the power of wealth building through real estate to fund the ADU down the road. So we also minimize our capital when that time comes. But we also then, we jump in as an early adopter to ADUs, but we hold on for 2 to 3 years and we implement the ADU when the process becomes far more known. So we know this is coming, right? Like it's been announced. And again, we have the playbook from the second suites. We kind of know exactly what this looks like. Each municipality is going to roll it out one by one. Process will get more and more clear. The reno costs, the reno process, the unknowns around the reno will all become more and more certain over time. So what a strategic way to engage into this landscape is to buy and implement the known and set yourself up for the early adopter phase of the ADU, right? You get the best of both worlds by doing so. So let's talk a little bit about what we look for in a market. So we pick select markets throughout the GTA to work in. Largely, those are based on a few different things, but there's lots to be said about market research. What we're really driving at here is that you can be a market research analyst. You can become an expert at this. If you, but we have to be careful how we allocate our resources, right? Because there's, you could become a financial modeler, you could become a contractor, you could become an expert in all of these areas. Now, when it comes to market analysis and market research, if you didn't want to kind of allocate all of your resources into this bucket, but you wanted to follow a very secure recipe, that would come down to a few different macro steps. We want to look at land scarcity, which we covered in the GTA with the green space and the water down below. A landlocked situation where supply and demand is fundamentally in our favor as owners and investors is quite good. You want to look for large transportation. This is where the municipal planners and the city planners are broadcasting growth, right? And they're very predictable with how they do this and what happens afterward. So much so that step 3 is big development follows transportation improvements. We've seen this over and over and over again. Big development is like in the east, we've got the Kedron development, which is just massive. 12 new schools, 22,000 new homes, huge developments, right? And with that comes all the super malls that go with that. Now, if we followed land scarcity, so supply and demand and good metrics related to that, which we have in the GTA, followed by large transportation, which we see in the east, north, and west in different ways, followed by big development, which again, we see in east, north, and west in select markets, especially. And then we follow that. That would be a very simple and straightforward recipe where you could have 99% of your ground covered by following those markers without becoming the research analyst and specialist yourself, right? The municipal planners, the big development firms in particular, have research teams. Let's piggyback off their efforts. So this is a very tried and true way to be able to predict where the market's going and then invest in those markets. So where do we invest? And where do we help investors invest? Well, through a number of different markets in the east, west, and north. In the east, Durham region, Peterborough, also not covered here, but we do cover is Coburg, Port Hope, Belleville, Lindsay, all of those markets. In the north, mainly Barrie and Orillia. In the west, Hamilton, St. Catharines, Niagara, Brantford, Kitchener, KWC. These are the markets that we focus on, and they fall into one of 3 buckets, generally speaking: a primary, secondary, or tertiary market. And this is really important. That kind of macro identification or label that we're putting on these markets is important, because I mentioned, step 2 in our process by which we consult and advise and help investors with talks about how much capital and how much title qualifying power do you have. Those data points feed directly into what markets will fit you best: primary, secondary, tertiary, as well as a few different things: your preferences, your proximity, your geographic location relative to these markets. There's a number of different things that go in, but what's really important is it's not a one size fits all, not in geographic location, not in the markets like primary, secondary, tertiary, not in the strategies you implement, not in renos, not in whether or not you do renos, not in how you force appreciation. All of these things can be adjusted and tailored to the specifics of your skill set, your risk tolerance, your preferences, your goals. And that's where the consulting comes in, right? This is not there's lots out there that says, I did this and you should do it too. We're just not big believers in that. We have our strategies that we implement because they fit us really well, but we also have the breadth of experience and depth of experience to be able to recommend other strategy if and when they fit you better. And that's really, really critical. So these different markets are throughout the GTA. They're here. Again, we have this, kind of library of options at our disposal here in the GTA, which is phenomenal for us as investors. Okay, let's look a little bit about what's been going on here in the market. So I'll show you 2 charts here. One is in a primary market, happens to be in Durham. The other one is in a secondary, happens to be in Peterborough. Both of them are behaving in a very similar way with slight differences for each. But ultimately, when we look at these graphs, right, what do we want to take note of? This is over the last 10 years. We want to take note of this green line. And what we propose is make your strategic decisions, your larger decisions, like should I invest in or not? How much of my portfolio should I allocate to real estate? These decisions, make it from your green line, or make it from the 53-year trend we talked about, or the 150-year trend. Those are the macro data points that we want to operate and make our bigger, more strategic decisions from. The blue line is the shorter trend here that we've seen over the last 3 years, 2 years. That line is also important, but it more factors into more micro decisions like what market are we in? Is it buyer or sellers? How do we craft our offer strategy? How hard can we push and how aggressive can we be when we're making our offer? Those are the more micro variables that get influenced by this shorter term line. So we see the green line and the blue line pretty irrefutable. They dovetail well into the 53-year trend and the 150-year trend. Very strong trend of growth. We also see a spike that happened early this year in 2022, followed by a pullback, right? And that's also important, very important as we, so why did that happen? Why did it happen? How do we interpret it? What does that mean for us as investors, as owners, and as buyers? All of those things are really important questions as it relates to what's going on there. Now let's look at the Peterborough market. Very, very similar. The green trend and the blue trend are, again, details slightly different, but ultimately the very same picture, as well as a spike earlier in the year, followed by a bit of a pullback. Now let's look at the last year, right? So this is running from roughly a year ago, about 13, 14 months ago. We see this sharp incline happening, followed by a bit of a pullback again in, starting in April. We'll see the same thing in May, a little bit more of a drop. So this is really important. So why did this happen? Mainly because of the interest rate hikes. So they've been talking about interest rate hikes for a while. The question as they announced their plan for interest rate hikes was how much of this is conversation about hikes so that it influences the market versus how much will they implement? That question is still on the table in our opinion. And so really important. I'll show you one more slide here from the West, very, very similar set of data points. We'll talk a bit more about this, but watch the broader trends and think macro. I'll explain what I mean here in a second. And as always, stress test your deals. This is, in the market that we've had for the last 2-3 years, stress test your deals. Headed in 2017, where there was a pullback, stress test your deals. Same thing now, right? We're seeing a bit of a pullback. This pullback should influence a couple of things. It should influence how you think, meaning we want to cut through the surface and get down to the foundation of the investment and the macroeconomic factors that we just covered. That's really important, right? We want to be able to stay steady and focused throughout these changes. Because again, everything is always in a state of adaptation. Us, everything on the planet, the real estate market, all of it. And that's critical to know so that we stay focused on the things that really matter when it comes to decision making. Okay, so this is in the West. Same thing, a sharp increase followed by a bit of a pullback. And again, caused mostly by interest rate increases. So we'll mention a couple of things here. So what do we make of this? It should influence the strategies we pick. So right now in a market that's correcting is a riskier time to do flips. So be careful of flips. For BRRRRs, every day is a good day to make a good deal. And so we did a pretty in-depth analysis of the correction of '89, which was one of the largest corrections we've seen here in the GTA over the last 50, 60, 70 years. That analysis was really critical. What we were setting out to prove or disprove was the old adage in real estate of it's better to have time in the market than try to time the market. Meaning don't be so concerned about the appreciation this month versus last month. Be more concerned with the fundamental criteria of doing a good real estate deal. For us, that is strong markets. It is good homes and good neighborhoods and good areas and cash flowing. If you do that and you stress test your deal and it's going to cash flow even through interest rate hikes or rent decreases, that's where you've got a good deal, and every day is a good day to make a good deal. The analysis that we ran, and again, our contact information will be at the end of the presentation. Feel free to reach out to us. We'll send you that video as well. Just shoot us an email. Hey, I want this report, this video, whatever that is, or whatever it might be. We'll send that through to you, no problem. Ultimately, when you look at the correction of 89, what we set out to prove or disprove, again, was the old adage, is it better to time the market or spend time in the market? So we took the very peak of the market in 89, and then there was a 13-year correction. And we said, what if you had a crystal ball and you knew where the very peak was, and you also knew where the very bottom was? Who makes more money? The person who buys at the very peak, or the person who waited 6 years and knew where the perfect bottom was and bought then? Who makes more money in 15 years from 89? And ultimately, with cash flow, mortgage pay down, and appreciation all factored in, the person who buys in 89 with the fundamentals in place makes more money in 15 years than the person who bought at the very waited and bought at the very bottom. That's super important. We did that analysis because we wanted to know the answer ourselves. The adage is interesting and has been around for a long time, but we didn't want to assume that was true. So we ran the analysis ourselves, and it proved to be true based on the data. Now, that's really important. So we look at, what are the corrections we've seen? We've seen 89, 05, 17, and now a bit of a pullback here. How much remains to be seen? But in all cases, including the biggest one we've seen in the last 60, 70 years, like I said, every day is a good day to make a good deal, meaning don't wait, depending on the strategy, right? In flips, not so much. In BRRRRs, in residential, in these fundamental living quarters, right? Call it the 2,000 a month, 2-bedroom, 3-bedroom apartments, that buy and hold, that BRRRR model that we're talking about, every day is a good day to make a good deal. Just be careful. If you want to wait, just be careful, because you can kill a lot of years waiting. It's either going up, and so it's more this month than it was last month, and so I should wait, or it's going down and maybe it'll be less next month than it is this month and I should wait. We don't have that many windows of time in our investing careers to sit and wait. And the good news is we don't have to. If we look at the data, look at the analysis, and fundamentally agree with the idea that a good home and a good market and a good neighborhood that cash flows, that last part is super important, that cash flows, is going to be good almost regardless of what the market does, if we believe in that 150-year trend, if we believe in the 53-year trend, if we believe in the last 10-year trend that we just showed you, then cash flowing properties that are fundamentally in good markets where supply and demand are in our favor, where the macroeconomic factors are in our favor, then every day is a good day to make those deals, and don't wait. Because again, like I know from early in my career, like I said, if I had known about BRRRR and buy and hold earlier on, like since 1992, I would have done far more of those and less flips. Nothing against flips. I still do flips. They're great. It's not, that's not what I'm saying. What I'm saying is that the buy and hold is a far more powerful wealth generator most of the time and through more markets than the flips are. And so again, just be cautious of taking these data points and going into a kind of a paralysis mode. I would encourage you not to, but rather to investigate the data, investigate history, so that we can learn from it and keep moving. So are we doing this? Absolutely. We bought a duplex 3 months ago. We bought another one about 2-3 weeks ago and are in the midst of converting it. We're on the hunt for more properties that fit that criteria because, I myself have lived through 3 corrections. I myself, early on, one of my main influences to get into real estate investing, had no hesitation early on. And I had hesitation. I've already been through this plus 3 corrections. I've already seen how this plays out. And so there's recipes to follow for sure. It's not just keep moving and keep acting, but follow those recipes and they will produce more wealth over time than waiting. All right, so some examples of apartments in the GTA. And again, these are, we're doing BRRRRs in these apartments, and which is a different criteria and model for BRRRRs. If you're interested in multifamily, let us know. We do quite a bit in this space. And some of the second suites that we've implemented over the last few years in different markets in the north, east, and west of Toronto. All of these, again, you'll see they kind of tend to fall into this recipe of single family bungalow, typically, 60s era. But all of these good fundamental investments with strong wealth building components that are producing wealth for investors. This, again, this is not rocket science. There's another saying, another adage in real estate investing. It's easy, but it's simple, but it's not easy. There are challenges in it. It is a business. If you want true passive, look at partnerships. If you want a business though that creates a lot of wealth, just know that there's effort and knowledge to be had there, but there's a good reward for this, which is why it's so compelling. So we talked about this hybrid model, right? We talked about buying properties, putting in second suites, and setting them up for a phase two, 2 or 3 years down the road of an ADU. This is a property, one of our clients just finished converting this. It's like literally just steps away from getting its certificate as a legal 2-unit dwelling. Look at this plot of land, like it's just massive. This ADU is good size, but it's not even close to kind of dominating the land space. There's so much property here. This one was phenomenal. Another one, again, one of our clients here, great location, and a nice big backyard. This one, again, is also almost done being converted, and the ADU is slated for 2-3 years down the road as a phase 2 approach. This one, again, this is one of ours, backs onto a golf course, massive backyard, nice and flat, huge space. You can have this ADU and have good backyard space for both tenants in the main dwelling easily. So this is super important, right? Again, this will be a phase 2. On this particular property, we have the ability to add another bedroom in the main unit down the road and add the ADU as well down the road. So we're always looking for ways, not just to force appreciation, but also for future opportunity so that this thing can keep paying off for us over time as density increases more and more and more. Again, this is not rocket science. We're not splitting the atom here. It's just really important to understand the fundamentals and make sure you're setting yourself up for that future kind of continued growth over time. Another property here, again, this one's almost done being converted, slated for an ADU, big backyard, which is huge. Excuse me, I've got a little scratch in my throat. The exact same recipe, right? This is the hybrid model. The ADU will be implemented down the road. But for now, second suite, well underway, almost completed. So let's look at, we kind of, we'll start with a few different things here. Ultimately, so I'm just explain what we're about to dig into. So in the same way that we started with, tiers of data as it relates to why real estate is compelling, we're doing the same thing here as we look at financials. So we do a lot of financial modeling, a lot of financial analysis, strategic planning. This is a bunch of how we run our business and how we consult with investors as well. In this case, we're going to start with an individual deal. And what does it look like to do a second suite? What does it look like to do both a second suite and an ADU? But then also, what about how a deal behaves over, not just for the first forced appreciation, but over time as the market and the wealth building kind of components of the investment continue to do their thing? How does it behave in year 3, year 6, 9, 12? So we'll look at an individual deal and how it behaves over a longer period of time, because that's a more realistic view of these investments and what they do. And then lastly, we'll look at a strategic plan that we put together. The idea here isn't that this plan is your plan. It's more that the strategic plan shows a couple of key things. And this is more about portfolio management, not just a individual deal and what it's going to do over the next 6 months, but and not just a deal and what it's going to do over 12 years, but a portfolio and how to grow it, how to minimize your effort and maximize your return. That's what the strategic plan that we'll show you is all about. So ultimately, this is, our one-page analyzer. This is the start of how we analyze a deal. It's meant to be very concise, fast, tell us a story really quickly to help us understand, do we want to get into this more? Do we want to pursue this deal more? And ultimately, do we want to chase it and go and land it and own it? So this happens to be in a secondary market, happens to be Peterborough. You look at a purchase price of 680, short-term capital around 300,000. That includes closing cost, down payment, reno, holding. Long-term capital around 163. So you can see that at around the 6-month mark, give or take, you would be able to refi and pull out roughly half of the capital that you put in, put that back in your pocket. This property would cash flow from around 227 per month. ROI projected to be around 42%. Annualized simple return each year on your money. Now that's an individual deal. Net profit in 5 years projected to be around 340,000 after your 163 is paid back. Again, this is simple, but it's not easy, but the returns are significant, right? And so this is one property. Think about having 5 properties. What kind of wealth is that going to build you? So now let's look at a deal where we also purchase and put in a garden suite along with a second suite. Again, same purchase around 680. Short-term capital in this case is 500 because it's the big bang approach. It's both all at once. Long-term capital around 200. So we're going to refi in this case, pull out a projected 300,000 of our 500 that we put in the beginning. Cash flow though, $1,100 a month. ROI projected to be 49%. Simple annualized return. Profit, 486,000 in 5 years, projected profit. So why is this important? To me, there's lots of compelling data points here. We want to understand our capital for sure, but look at that cash flow, $1,100 in cash flow per month. Now, what does that tell me? This is kind of, back to our hybrid model and this first mover advantage. What does $1,100 in cash flow represent? Think back to second suites. Remember I talked about that first mover advantage and what comes along with that. What you get is more inventory, more options, because not everybody knows about it. Not everybody's picking them over. Not everybody's looking for them or knows how to find them. So you get this, more inventory option in front of you, which is really nice. You also, though, get more cash flow and you typically get a higher projected ROI. Now, here's something that we believe we know. $1,100 in cash flow is not going to sit on the market for very long. Meaning if I snap my fingers and put 1,000 properties on the market that cash flowed for 1,100, investors would come from all over Canada and buy those properties, force up the value until there was about 200 left per month. Why does that happen? Well, there's a real strong connection in the investment world in general, but especially in these duplexes and garden suites. There's a real strong connection between the monthly cash flow, the interest rate, and the rents, because investors, these properties are very fruitful, and more and more people know that and understand it over time. So what would happen? Why would people flock from all over Canada buy properties at 1,100 cash flow? Because that's a ton of cash flow. The money would go up until there's 200 less because people aren't willing to lose money. Generally speaking, there are exceptions, but mostly people aren't willing to bleed cash every month. They will pay more and more and more until there's around 200 left though. So what does that mean for these properties? Well, when I set myself up to be able to do this ADU as a phase 2 down the road, not only do I get good cash flow, but I've almost, nothing's a guarantee. I'll stand 1 degree shy of saying the word guarantee, but very, very probably I've set myself up to purchase property, put in the second suite, let it do the wealth building thing, put in the ADU, have it cash flow really, really well, but also as the icing on that cake, more future opportunity of the value of that property going up and up and up over time until the cash flow hits around 200. So I'll get probably more and more refis out of that 3-unit property now that I just created, which is huge, right? Like this is purchasing a property today that is more than likely, very probably set up to produce more and more refis, more and more wealth and cash flow while it does it for the next 5-10 years. And that's why we kind of dichotomized this and said, what's gone on for the last 10 years? What's more than likely to go on for the next 10 years? How do we just kind of be really smart about this and set ourselves up to take advantage of the landscape, right? Be smart and engage into it.
Chris, I just got one question in the chat was, what is the minimum size of the garden suites?
So minimum size, think around 400 square feet. You know, you really want one bed, one bath at the very minimum. Oftentimes the garden suites are, there's a couple of kind of guiding principles there. 10% of the lot size, can't be bigger than the main dwelling, are some of the guiding principles around, you know, other municipalities and how much they put in. The minimum size though, yeah, I would think around this, you know, 400 square feet would be right around the minimum. Thanks, Paul, for letting me know. And so this chart here, as I mentioned, you know, we just talked about two deals and a point in time for those deals and a projection on them. Now let's look at, you know, how does a deal behave over the next 12 years? So this chart ultimately is showing, the blue bars are showing the capital that you have tied up in the deal. The red line is showing the ROI at each stage. So each blue bar represents, in this case, just the way this one's modeled, is a 3-year time frame. And each 3 years, we're refinancing, pulling capital, putting it back in our pocket. When we do that, we know that ROI is just a relationship between profit, capital, and time. So what happens when we pull more capital out into our pocket? One, we can do more investing with it. And two, our ROI jumps up on the property because we have less capital in it. So here we start with, you know, this is just a simple turnkey duplex. On day one, we have 154,000 tied up into it, and our ROI is projected 30%. That's very standard for turnkeys. They tend to land around 30%, simple annualized ROI projected. And BRRRRs tend to land around 50%, although that ebbs and flows, they tend to land around 50. So you're largely getting rewarded with a stronger ROI for putting up more capital, doing more rentals. And so in the beginning, this the first phase of this, 154,000 in capital, 28% ROI. 3 years down the road, we refi again. We put in, you know, roughly 70 grand in our pocket to go do more investing, if we so choose. ROI then jumps to 82%. Another 3 years, we put another 50K back in our pocket. ROI jumps to 243%. Now, in the last 3 years of this 12-year review, we refinance again. Now our ROI is 438%, and we only have 21 grand tied up in the building. This is a relatively conservative model. The way the market has been for the last 5, 10, 15 years, it's far more aggressive than this, but this is, again, what this really is doing is showing us that, you know, that a lot of BRRRR financials are modeled for the reno and then a 5-year projection, and that's great. But the deal is far more powerful than that. And even a simple turnkey without even the forced appreciation aspect or the ADU or any of the other interesting stuff that we talked about still behaves in a very, very powerful way and allows us to do more investing and increase our ROI, get our money working harder and harder for us. So and this is where it leads into the next kind of view that we'll show you. So a Blue Orchard strategic plan. So what were we trying to do here? So let me just contextualize this a little bit more. So what we're really talking about here is we talked about an individual deal, how it behaves. And then we talked about how an individual deal behaves over a longer period of time. Now we're talking about a portfolio. So what are we setting out to do here? We're trying to obviously build wealth. And in this case, so retirement wealth, legacy wealth. But in this case, we're also looking for income replacement of around $9,000 per month in cash flow. And so there's a simple two-phase strategy here. There was a few models that we ran. This one trumped the other ones by a pretty large margin. And this thing says this kind of study, this model shows some things very definitively. And so let's get into this. Phase 1, we acquire 6 duplexes in the first 6 years. Phase 2, in year 12, we sell 3 to pay off 3. So what does that mean? It means we're starting with 300 in capital. We're going to buy a couple of duplexes. And again, the market to be determined. This is probably more of a tertiary market. And again, this isn't your plan. That's not the idea. But the idea is take a look at what strategic planning, stepping back and being smart about how we engage can do for you and what it tells us. It's really very important and quite compelling. So in this case, we're taking 300 in capital. Phase one, we're going to buy duplexes. We're going to be acquisition mode. So we're going to buy 2 duplexes to start. We wait a couple of years, and I'll show you that chart here in a minute. We buy another one, buy another one, buy another one for 6 years, and then we own 6. And then for a period of time, 5.5 years, we let them do their wealth building thing. And then we sell 3 of them, 3 of the 6, and we use the profits from that to pay off the other 3. And now we own 3 duplexes outright in 12 years. So let's look at this. A total of 300 capital is invested. In 12 years, our gross profit, if we were to dispose of the portfolio, or would be 3.5 million. So 3.2 million in net profit after we pay back our 300 that we put in. And ultimately, you know, we see the spike and we infuse capital of 300. We buy 2 duplexes and we sit at this. You know, our capital remains quite low because we're being as aggressive as possible in acquisition mode as we can be. Now, what's happening here? Well, we're doing refis and we don't need all of the capital from the refi for the next purchase. So some goes back in our pocket. That's what these 2 stair steps are here. So this is our, you know, the chart of our capital. And now let's look at the acquisition disposition schedule. So as I mentioned, in day 1, we buy 2 duplexes. Now we own 2 buildings. We wait a couple of years, we buy 1 more. 1 more year, 1 more, same thing. Now we own 6 of them in roughly the first 6 years. Now we stay in a stabilization mode, and here we sell 3 and keep 3. And that's, think of the simplicity of this model, right? In the investing world, you hear lots of people talking about 50 doors, 100 doors, 300 doors. And there's nothing wrong with that at all. What we're here to tell you though, is you don't need to be running a portfolio that big to have income replacement, to have legacy wealth, to have retirement wealth, to set yourself up extremely well based on the data that we're citing here, the 150-year study, the 53-year, the models that we know work, the recipes. So what is a good investment? We know what that looks like. Now, our equity over time. So the red line is our resale equity. The blue line is our refi equity, meaning, you know, how much could we refi at an 80% LTV? So we see this growing over time, right up to 3.5 million in net worth in that 12-year time frame. So what do we see here? We see capital invested 300, a 12-year plan, very, very simple 12-year plan of 6 duplexes, 3 owned outright in 12 years. And again, net profit of 3.2 million, cash flow 9,100 per month, total ROI of 1,086%, annualized 91%. That's over the portfolio. And so this is the data that drives this is a massive spreadsheet that I built that includes market appreciation, it includes rent increases, it includes utility increases. Everything is built into that spreadsheet, mortgage amortization schedules across all your refis. So it's a ton of data rolled up into this report that ultimately tells you a couple of things. Again, this is simple, but it's not easy. We're not splitting the atom. This is not rocket science. We're simply engaging into a data set that is well known, is well established, and through some education and knowledge sharing can be very well understood. And then we can be very smart about how we engage into that by not chasing doors, by not chasing deals, just any deals, but very specific ones with a very specific recipe where we set ourselves up for not just cash flow today, but future opportunity where it gets stronger and stronger and stronger. And that's huge, right? Like this is in our view, this is what it means to be a strategic and a smart investor. And set yourself up. Remember that graph that we showed you in the beginning, market appreciation versus income. Well, and the inflation that we talked about. How do we protect ourselves against that? We protect ourselves by being smart like this, by being as strategic as we possibly can be. This is super important to us. And you can tell from this view, like I said in the beginning, yes, we're a team of realtors. We are investors first and realtors second. And it's important to us to have this long-term view. Again, it has to be a long-term win, or it just doesn't kind of jive with our DNA. It's just, you know, how we're wired and how we run our company. So let's look here at, you know, what are the fundamental pillars of success? Education, information, again, informed action taking, clarity. If you're not clear on where you're going, then what are the chances of you getting there, right? Let's say we're driving to pick a place, Vancouver, New Brunswick, doesn't matter, but we don't have a roadmap and we don't have an idea of what highways we need to get on to go there. It's gonna take us a while. Focus. We need to know what we're doing and why we're doing it. What market, what strategy, what are our goals? Why are these strategies and markets going to hit those goals? So it's great to say every day is a good day to make a good deal, but what does it mean? Like, what specifically do we need to do to make sure that it's a good deal and we can ride out whatever market corrections or rent corrections are going to happen? That's the focus, right? Again, clarity is how are you going to get there? Focus is where are you trying to get to? What is it? Are we trying to go to New Brunswick or Vancouver? And for us, easily the most pervasive and root variable linked and correlated with success is mindset, because it affects all the others. It affects how and when you educate yourself. It affects your clarity, what kind of fortitude you execute on, and what kind of focus you have while you do it. Mindset is huge, and it's definitely, I mean, as we all know, it's not a one and done. This is one of the best things you can do for mindset is be around people that care about mindset, because those are the people that are constantly evolving. Those are the people that are sharing information freely and openly because they believe in abundance. They believe in having that information and giving it to others and having that be reciprocal. Like that's the group you want to hang around, right? Mindset is absolutely fundamental, and definitely, like I said, not a one and done thing, but rather mindset is something personally I can say I'll work on until the day I die, right? Like it's just a fundamental tenet. And so hopefully, guys, we've presented this information in a way that is very informative. And there's a couple of choices. You could take this information and very, very truly, right? Like if it's not a fit, if you heard all this tonight and you say it's what I know now is that it's not a fit for me. Perfect. It was time well spent, because real estate investing is a big thing that a lot of people talk about. And so if all it is ruling it out because now it's not right, well, fair enough. You could go it alone. I know I've been investing since '92. The education and training that we offer just simply wasn't available back then. Had I known, I would have moved much, much faster, for sure. Now, no regrets. A lot of that ground was covered well and very, very good learning, but there's easier ways to do it. Option 3 is to decide that it fits you and to take action. So what's the next step if you decide to take that action? Book a consult call with us, 15, 30 minutes. We can get into it. You can answer any questions that you have, learn more about us. And, we can kind of take it from there step by step. Is this a good fit? Do we want to work together? If so, how do we want to work together? What are your goals? What do your finances look like? And what market, what strategy, that whole process that we talked about earlier on. Book that consultation call. Here's our email, consultations@blueorchardpropertygroup.com. Feel free to reach out to us, and we'll be happy to book that call with you and set it up. All right. Well, guys, that's it for the presentation tonight. Thank you very much for joining. Hopefully you found it very informative. And we'll look forward to getting your emails and setting up some of those calls for anybody who feels like it's a good fit for them. We'll absolutely put that in place.